Welcome to Hedge Haven, your trusted guide to the shadowy world of high finance, where the ultra-wealthy play by their own rules and the stakes are higher than ever. We're here to pull back the curtain on Wall Street's best-kept secrets, exposing the risks, strategies, and hidden forces that shape the global financial system. Whether you're an investor looking to protect your wealth, a curious mind wanting to understand how money moves behind closed doors, or a policymaker seeking clarity in a complex world, Hedge Haven delivers hard-hitting insights, deep dives, and actionable knowledge. Our mission is simple: to empower you with the truth about finance so you can stay informed, stay alert, and stay ahead. Today, we're diving into a story that the financial media has buried and the public has forgotten, but one that hedge funds, sovereign wealth managers, and the titans of finance are studying closely. It's the story of Archegos Capital Management, a collapse that shook the world in 2021 and left a blueprint for chaos that's more relevant than ever in 2025. This isn't just a history lesson, it's a warning about the hidden risks lurking in today's markets. Let's get started. The financial media has largely moved on. The public forgets, but hedge funds haven't. Sovereign wealth managers haven't. They've studied Archegos. They've dissected its rise and fall. They've refined the tactics, not to reduce risk, but to better conceal it. In the shadows of Wall Street, the lessons of Archegos are not about caution. They're about perfecting the art of deception. And don't think for a second that this only affects the ultra-wealthy. When Archegos collapsed in 2021, the shockwaves didn't just ripple through the gilded halls of hedge funds and investment banks. They hit pension funds, mutual funds, exchange-traded funds, ETFs, the very investments that millions of ordinary people rely on for their retirement, their children's education, their financial security. That web of interconnected risk is even tighter now. In 2025, a hidden collapse in one shadowy institution could spark a chain reaction across every major financial market in the world. That's why we're telling this story at Hedge Haven. Not to revisit the past, but to warn about the present. Archegos isn't just a name from 2021, it's a symbol, a red flag, a blueprint. We believe that understanding the financial system's past failures is the key to avoiding future disasters. This is not a history lesson. It's a wake-up call for investors, policymakers, and anyone who wants to understand how the ultra-wealthy move money behind closed doors. Hidden leverage is still here. Market opacity is worse than ever, and the illusion of control is stronger than it's ever been, because the financial system doesn't crash when everything looks shaky. It crashes when everyone believes nothing can go wrong. What was Archegos? A house of cards in plain sight. To grasp why Archegos matters today, we need to start with what it was and how it unraveled. Archegos Capital Management was a family office, a private investment firm managing the personal wealth of its founder, Bill Hwang. Unlike traditional hedge funds, family offices face minimal regulatory scrutiny, allowing them to operate with a level of secrecy that would unsettle most investors. Hwang, a former protege of legendary hedge fund manager Julian Robertson, had a reputation for bold bets and a knack for navigating volatile markets. But in 2021, his empire imploded, exposing the fragility of the global financial system. At its peak, Archegos controlled over $36 billion in assets, but its real influence was far greater. Through a financial instrument called total return swaps, Hwang amassed massive positions in a handful of stocks. Companies like Viacom CBS, Discovery, and Chinese tech giants like Baidu and Tencent, without ever owning the shares outright. Total return swaps allowed Archegos to borrow money from banks to amplify its bets, leveraging its portfolio to control hundreds of billions of dollars in stock exposure. For every dollar Hwang invested, he wielded $5, $10, or even $20 worth of market power. This strategy worked as long as the stocks went up, but when they didn't, the house of cards collapsed. In March 2021, Viacom CBS announced a secondary stock offering, diluting its share price. The stock plummeted, triggering margin calls from Archegos' prime brokers, major banks like Credit Suisse, Morgan Stanley, and Goldman Sachs. These banks demanded Hwang post additional collateral to cover his losses, but he couldn't. As the banks raced to unwind Archegos' positions, They flooded the market with sell orders, driving the stocks even lower. The result was a vicious feedback loop that erased billions in market value in days. The fallout was catastrophic. Credit Suisse alone lost $5.5 billion. Nomura reported losses of $2.9 billion. Other banks, including Morgan Stanley and Goldman Sachs, took hits in the hundreds of millions. But the damage wasn't confined to Wall Street. The stocks Archegos had bet on were held by countless mutual funds, ETFs, and pension funds. When those stocks tanked, everyday investors, teachers, firefighters, small business owners saw their portfolios suffer. The interconnectedness of the financial system meant that no one was truly insulated from the collapse. You'd think a disaster of this scale would spark sweeping reforms. Archegos exposed glaring weaknesses: excessive leverage, inadequate risk management, and a lack of transparency in derivatives markets. Regulators promised investigations. Politicians demanded accountability. But 4 years later, in 2025, the system is arguably more vulnerable than ever. Why? Because the incentives haven't changed. Hedge funds, family offices, and sovereign wealth managers are still chasing outsized returns in a world of low interest rates and market saturation. The tools that enabled Archegos, total return swaps, synthetic derivatives, and other complex instruments, are still in use. And the institutions meant to police these risks, from prime brokers to regulators, are either complicit or outmaneuvered. Let's break down the persistent failures in 2025. Hidden leverage. Archegos used total return swaps to amplify its bets without disclosing its positions. These swaps allowed Hwang to evade SEC reporting requirements, keeping regulators and investors in the dark. Today, derivatives markets are even murkier. New instruments, like bespoke synthetic securities and off-balance sheet financing, let firms hide leverage in ways that make Archegos look rudimentary. The notional value of global derivatives markets exceeds $1 quadrillion, dwarfing the global economy. A single misstep could trigger a cascade of defaults. Bank complicity. The banks that lent to Archegos weren't victims. They were enablers. They extended billions in credit without fully grasping Hwang's portfolio or his concentrated bets. Why? Because prime brokerage is a cash cow, and banks competed for Hwang's fees. In 2025, this race to the bottom persists. Banks have tightened some controls, but they still rely on high-risk clients for profits. The revolving door between Wall Street and regulatory agencies keeps oversight weak. Regulatory blind spots. Family offices like Archegos operate in a regulatory gray zone, exempt from SEC registration and disclosure rules. In 2021, this allowed Hwang to build massive positions undetected. Despite reform calls, family offices remain largely unregulated in 2025. Meanwhile, the rise of private markets, where assets trade away from public exchanges, has further eroded transparency. The SEC and other regulators are underfunded and outpaced by finance's complexity. Market interconnectedness. Archegos showed how one player could destabilize entire markets. Its unraveling triggered volatility far beyond its targeted stocks. Today, algorithmic trading, passive investing, and ETF proliferation means shocks spread faster. A 2025 collapse could freeze credit markets, disrupt supply chains, and tank retirement accounts globally. Archegos was a wake-up call, but the financial industry hit snooze. Instead of reducing risk, hedge funds and others have spent 4 years refining their tactics, learning from Hwang's mistakes to execute them better. Here's the 2025 playbook, Synthetic Leverage 2.0. Total return swaps are just the start. Firms now use multi-layered derivatives, often via offshore entities, to amplify bets while dodging scrutiny. These structures are so complex that even financing banks struggle to assess the risks. Cross-collateralization. To skirt margin calls, firms pool assets across multiple brokers using the same collateral for loans from different banks. This creates hidden dependencies, where one default could trigger a system-wide domino effect. Dark pool trading, private trading venues or dark pools, let firms execute massive trades without moving public markets. Their use has surged in 2025, giving firms cover to build concentrated positions. AI-driven blind spots. AI has revolutionized trading, optimizing portfolios in real time. But algorithms can't predict black swans, and over-reliance on automation can amplify losses when markets turn. Think this is just a billionaire problem? Think again. Archegos showed that financial recklessness spares no one. A 2025 crisis could hit. Retirement accounts, pension funds and 401ks, heavily invested in ETFs and mutual funds, could lose years of savings in a crash. Cost of living, crises tighten credit, raise borrowing costs, and slow economies, leading to job cuts and higher prices. Taxpayer bailouts. Bank losses often lead to government bailouts, funded by your taxes. Global ripples. A New York or London crisis could disrupt markets in Tokyo, São Paulo, or Nairobi, halting supply chains and spiking inflation. What can be done? The system won't fix itself. Here's how to act. Demand transparency. Push for real-time. Derivatives disclosure and family office regulation. Strengthen oversight. Banks need stricter capital rules and stress tests. Regulators must curb conflicts of interest. Educate investors. Understand ETF risks and diversify to reduce exposure. Advocate for reform. Support policies prioritizing stability over Wall Street profits. In 2025, the financial system is a paradox, sophisticated yet fragile, powered by technology but held together by trust, greed, and denial. The illusion of control, fueled by bullish markets and central bank support, breeds complacency. But crashes don't strike when everyone's braced. They hit when confidence peaks, markets seem invincible, and warnings are ignored. Archegos was a warning. It showed what happens when leverage, opacity, and hubris collide. The next Archegos is out there, and its fall could shake the world. At Hedge Haven, we're committed to exposing these risks and empowering you with knowledge. Whether you're an investor, policymaker, or curious citizen, this is your call to action. Stay informed, stay alert, stay ahead. If this exposé opened your eyes, hit the like button to spread the word. Subscribe to Hedge Haven for more deep dives into finance's hidden corners, and click the bell icon to never miss an update. Share this with anyone who needs to see behind Wall Street's curtain, friends, family, colleagues. Together, we can demand a financial system that serves everyone, not just the elite. Join our community, stay engaged, and let's shine a light on the shadows. The next crisis is coming. Be ready.